So the Federal Reserve has chosen to cut the federal funds interest rate for the first time in more than 4 years. This takes the rate from a multi-decade high of 5.5%, where it's been since July 2023, to now just 5%. Now, if you had a look at your investments since the announcement, you've probably seen them go up as I'm making this video, unless things change as they normally do. Anyway, and potentially the stock market is soaring to new all-time highs. Now, putting that to the side for 1 second, I wanted to make a quick video just breaking this all down, explaining what's going on and try and answer the big question: does any of this really matter? Especially from the perspective of an investor based in the UK who's probably investing for the long run. Do we need to do anything at all? And if so, how do we need to react? First things first, let's just look at why this is happening. Just like the Bank of England, here in the UK, the US Federal Reserve is the central banking institution that sets the interest rate. This rate determines how much commercial banks get charged for lending money to each other, and it's got many effects on the wider economy for people like you and me, and the government too. These rates have a knock-on effect from everything to how much you might pay for a mortgage, a car payment, a loan, or even whether you get a pay rise at work. They can even affect the price of what you pay in the supermarket and at the petrol pump. Even if you don't live in the US, these rates will still have some impact on your finances, as the US is the largest economy in the world and is the home to the largest stock market. Anyway, it's worth first addressing quickly why these rates have been put up so much and so quickly over the first couple of years. Now, the biggest reason for this is inflation. Now, obviously, during the pandemic, rates were cut near zero and an enormous amount of money was flooded into the global economy, not just in the US, but all over the world. With more money available, prices increased on most products and services due to the basic effects of supply and demand. You had huge demand around with lots of cash, but supply wasn't able to match that with big parts of the world shut down. Prices then shot up for almost everything, and in response to that, the central banks increased their interest rates to reduce the supply of money going out into the economy. If you take a quick look at the chart for US inflation data, you can see that it peaked back in July of 2022 at over 9%. Now, bear in mind that this is just the average rate across all of the items that are measured, and other individual items went up by way more. I'm sure many of you also felt that. For example, food went up by more than 11%, and items like butter and margarine shot up over 30%. Energy prices, one of the biggest factors, peaked at over 40% on a year-to-year basis. And as you can imagine, these had a huge effect on everything, as this cost literally powers the entire economy. If you don't have any energy, good luck doing anything at all. Now, this all matters because if prices shoot up too quickly and get out of control, then this isn't good for anyone. High prices then drive higher wages, and you can end up with a bit of an upward spiral that can easily get out of control. Now, the biggest tool we have to keep inflation under control is central bank interest rates. Here in the UK, that would be the Bank of England, and in the US, it's the Federal Reserve. You may have seen just today that the UK central bank, the Bank of England, has kept their interest rates at 5%. Now, because the dollar is the dominant currency around the world, any moves they make have a much greater impact, as you can imagine, than the Bank of England. So any move up or down gets a lot of attention from the global markets, and people like me will make a video about it. On a quick side note, if you want to join like-minded people who love talking about investing and all things personal finance, then please do consider joining my Discord community. There's a link in the description below, and once you sign up and pay the small fee, you can jump right on, and I'll be looking to grow this over the coming years with exclusive events and different live streams. This also helps support the channel too, as I don't take any sponsors and have never been paid to make a video on this platform. Anyway, back to this video. I think the best way I can explain interest rates and how they work is to remember that money itself has a price. So take this banknote, for example. It doesn't really matter what the number is, but just imagine this scenario. Let's say that you have two options of what you can do with this money. You can either give it to me, and in 1 year, I'll give you £21 back, or you can use it for something else, maybe even invest it into the stock market or even put it towards a new car. Either option's up to you to decide, and there's even technically a third option, which is probably the most important one. Now, the third option is I can also lend you more of these banknotes, and I'll give you these if you pay me some interest. So in this example, I'll say that in 1 year's time, I want you to give me back £21.50 for every £20 that you've borrowed from me. This is what I mean by the fact that money has a price. If the interest rate was high, you would get more money in interest by leaving the £20 with me and saving it. And money would be more expensive to borrow because I would expect more money to be paid back to me for taking the risk. As you can imagine, when interest rates are low and it's cheap to borrow money, more people and businesses will borrow money and use it for all kinds of reasons. Whereas on the flip side, when interest rates are high, money becomes expensive to use and there is more of an incentive to save it. Now, when less money is out there in the economy, this will usually drive prices down, and it's the same for the opposite way. More money can also drive inflation unless the supply side also matches up. Now, from an investment perspective, here's where things get interesting and we can start to talk about what this might mean for you and me in the stock market. So generally speaking, if the interest rates are low and there is almost nothing to be gained from saving your money and leaving it with me from that previous example, money will get spent and invested in other areas of the economy where people think they can make the most from it. For example, they might choose to invest in the stock market or in the real estate market, as these have been historically what have done very well in the past. Likewise, if you wanted to start a business or refinance some debt, you're more likely to take it on with a low interest rate because you think you can make more of it in the future. Just think of this, historically speaking, the stock market has delivered about 10% a year as a long-term average rate of return. Now, it also carries a lot of risk and none of that's guaranteed. However, you have to weigh this up with saving your money and doing something else with it. When interest rates are low, the gap between what you can expect from saving your money and what you can get if you invest becomes much larger. So that level of risk that you take by investing becomes a lot more attractive. You could say that there's better risk reward for you personally. However, when interest rates are high, like they were most recently, then the gap between what you can get with no risk in a savings account compared to a risky stock market becomes a lot smaller. Now, the fancy term for this is called the equity risk premium, and it's a careful balancing act that can be pushed in any direction by the changing of these interest rates. It definitely can't be stressed enough just how important it is that you actually understand them, and Warren Buffett once described it nicely when he said that interest rates are like gravity on the stock market. When they're high, they can push prices down, and when they're low, stocks can go to the moon, where there's almost no gravity at all. Anyway, what can we learn from the past about what we can expect to happen next? Now, here's where things get a little bit interesting. Well, let me show you something on screen now and share with you some thoughts from the industry too. This is a long-term chart of two important bits of information. You've got the blue line as the price of the S&P 500, which we can use as our benchmark for the stock market. Then you have these red bars, which are the US federal funds rate. We can also add in the recessions here in the vertical grey bars, which have occurred 6 times since the 1980s. That's as far as we're going to go back on this one. Let's ask the question first. Do low interest rates mean that the stock market will go up? And what about vice versa? When rates are high, has this normally been bad for the markets? Well, if we take the period around the dot-com bubble as an example, we can see that the stock market went up during a period where interest rates remained relatively flat. The market went from around 500 points to 1,500 points between 1995 and the year 2000, where interest rates remained almost flat between 4.75% and 6%. Now, we know in hindsight that this period ended up with a major stock market crash over many years because of the huge valuations that were put into internet companies, and people were investing money out of fear, chasing those potential gains. You can argue here that valuations were completely skewed, and without that bubble, you could make the point that prices may have stayed quite flat with those interest rates remaining where they were. Unfortunately, unless you can rerun history, then we'll never really know. Now, what about a second example? The global financial crash is a good one because there was a lot going on both before the crash and after it. Now, before the crash, you can see that interest rates were slowly driven up from the late 2004 all the way through to 2006 and beyond. The stock market did rise from around 1,100 points to around 1,500 points. So this would be the opposite effect of what you might normally expect to happen. Then, as the market crashed due to the unraveling of the subprime mortgage crisis, interest rates were cut to almost nothing, a recession occurred, and the stock market took a long time to bottom out before it finally started to make a move again. The period after the global financial crash is also interesting, as this is a kind of what you might expect to happen with low interest rates. The market entered a bull run, which you can argue is still taking place today, and it went from around 800 points to around 2,000 before the rates were moved up again. And even at that point, up until the pandemic, rates went up and the stock market also moved up with it. So make of that what you will. Drawing any kind of future stock market prediction from this data, in my view at least, is very foolish, and I really hope that long-term investors don't make decisions based on it. At each point, so much is going on and so many factors can play into stock market valuations. It's a forward-looking market and there are many players involved, all of whom have different objectives. I mean, I haven't even gone into anything about money supply or anything like that that you could even put onto this chart. If we look at some other opinions out there, JP Morgan thinks that the probability of a recession in the economy is about 50-50. They've raised their own expectations of a recession taking place by the end of this year from 25% to 35%. They said, and I'll quote you, "Important elements of our growth forecast are being challenged. US news hints at sharper than expected weakening in labour demand and early signs of labour shedding." The latest business surveys also suggest a loss of momentum in global manufacturing area and in the euro area, weak links in the expansion that we have expected to lift this year. On the other hand, these forces are being tempered by solid continued gains and overall activity led by the service sector. He then adds, however, the vulnerabilities associated with a recession, such as sustained profit margin compression, credit market stress, and energy or financial market shocks, are notably absent. Now, if you ask me, that's about as much as you can say, and you're sitting right on the middle of that fence. Nobody can know the future, and they're just guessing what might happen. Saying there's a 50% chance of a recession is like me saying, I might have a pizza later, or I might not. I probably won't because I had one last night, but you can't stop me if I want to have another one. So anyway, take of that what you will, but I don't think you're going to take really much value from that. Another perspective is this one. An equity manager quoted in this TrustNet article shows us some interesting past data that you might want to hear about. He says, unsurprisingly, in cases when the first rate cut was followed by a recession, performance looks very different compared to cycles when no recession occurred. US equities dropped on average by 4% in the 12 months after the first cut if a recession hit, but rose by 18% if no recession occurred. In other words, anything is possible at all. It all depends if there's a recession or not. And secondly, here's another little gem. He says, if no recession occurs, equities typically outperform treasuries by a remarkable 15% over the following 12 months. Also, if you're interested, you can go into all of the details about what kinds of sectors in the stock market tend to do well or poorly in the event of a recession. In the top right of this graph, you'll see the areas which tend to do well, like healthcare and consumer staples, things you can argue are needed no matter what happens to the economy or to interest rates, whether we have a recession or not. Now, just putting all of that to one side, what does any of this matter to me and you, assuming we are long-term investors? If we have years ahead of us and we're buying the whole market or maybe just making the most of low-cost index funds, do we need to do anything now as a reaction to these interest rates being cut? Well, in my humble opinion, we need to do absolutely nothing. Now, interest rates are just another part of the investing world that are completely out of our control, in the same way as we've got no idea if a recession is coming or not, and where the bottom of the stock market might be. Now, for me personally, and I can only speak personally, I'm happy with the long-term risks of investing, and I make sure that I invest what I can afford, and I always presume that I'm putting money away that I won't be touching for decades. However, for you, these risks might be too much, and you might make another decision. Remember, I'm not your financial advisor, nor do I ever claim to be one. Now, interest rates do play a careful balance about making saving more enticing compared to the stock market, and when lowered, they will, generally speaking, help boost returns of things like stocks as people seek those better returns. But do remember that the stock market doesn't just work as simply as that, and anyone just explaining things so easily when they look back in the past can still have no insight into the future. Just because something's happened once in the past and the stock market did something does not mean that it will happen right again. So making any kinds of predictions, in my view at least, is absolutely pointless. I make no judgment on the market. I carry on with my own plan regardless. Now, you might think that that's crazy, and I'll enjoy getting your opinions in the comments below. If you're changing the way you invest because of this rate cut, then I'll be very interested to let me know what you're actually doing. Do definitely let me know. Now, I wonder if by the time this video goes live, the market will have completely gone in the opposite direction. We shall see. I'll put it up now. Anyway, I'll see you in the next video. As always, happy investing.